What happens when someone at work needs a new laptop, raw materials for production, or a cleaning service? In many companies, the old answer meant emails, spreadsheets, paper forms, and somebody trying to track down an invoice weeks later. Welcome to another episode of Microsoft Knowledge Nuggets on M365 FM. I'm Mirko Peters, and today we are looking at Procurement and Sourcing AU, the connected process a company uses to buy goods and services from vendors. Think of it like one front desk in an office building. Every request, approval, order, delivery, invoice, and payment passes through the same place. We will follow one purchase all the way from the first request through the controls working behind the scenes. 1. What procurement and sourcing actually covers. Procurement and sourcing might sound like a long name for buying things, and it is about buying, but the two words describe different jobs. Sourcing is the work of finding and choosing the right vendor. Think of a company that needs gloves, helmets, safety signs, and protective glasses. Before anyone places an order, someone has to decide who can supply the right products at an acceptable price by the required date under terms the company accepts. That is sourcing. Procurement starts once the company needs to manage the actual purchase. It covers the request, the approvals, the purchase order, the delivery, the invoice, and the payment. Together, this process is called source to pay. The name describes the full path. A business identifies a need, chooses a supplier, sends an order, receives the goods or service, gets an invoice from the vendor, and then finance pays the vendor. Each step connects to the next. You would think that is obvious, but many businesses still run these steps in separate places. An employee sends a request by email. A manager approves it in a chat message. A buyer keeps order details in a spreadsheet. The warehouse checks a paper delivery note. Accounts payable receives an invoice that has no clear link to the order. People can still buy things that way, but they lose the thread. A buyer cannot know that the warehouse already received part of an order. Finance can end up paying the same invoice twice if it arrives through two different channels. Managers only discover the cost after the money has left the company. When someone asks who approved this, the answer means a long search through inboxes. Dynamics 365 puts that trail into one connected platform. Procurement and sourcing lives inside Dynamics 365, supply chain management, where a company handles the movement and availability of goods, and it connects with finance and accounts payable for recording invoices, tracking what it owes, and processing payment. So purchasing does not sit alone in a corner. The warehouse can record that goods arrived, finance can see the invoice tied to that purchase, and accounts payable can check what was ordered against what arrived and what the vendor billed. Each team sees only the part they need, while the purchase remains one connected record. Now there are two types of buying. Direct procurement covers goods or services tied to what a company produces or sells. A furniture maker buying wood, screws, and fabric is buying direct materials. Without those materials, it cannot build the product it sells. Indirect procurement covers the things that keep the business running, but do not become part of the item sold: AU laptops, office furniture, training, repairs, cleaning, software, or legal advice. Both are important, but they often start in different ways. Production demand can tell the company it needs more parts. An employee can request a new monitor. A facilities manager can need a repair service. Dynamics 365 handles all these different needs while keeping the purchasing path clear. Let us use one simple example through this episode. Imagine a warehouse manager notices the team needs new safety equipment. Oh, some helmets are damaged, the supply of protective gloves is low. The manager needs enough equipment for the team, and the company needs a clear record before money is committed. That purchase starts with a need, and every controlled purchase starts when someone asks for something. 2. From internal request to the right vendor. Here's how the whole buying process starts. Your warehouse manager spots a need for safety equipment, and the first record created inside Dynamics 365 is a purchase requisition. A purchase requisition is an internal request to buy something. It tells the company what a person needs, how much, and often where it should go. Notice that this request doesn't promise anything to a vendor yet. That distinction keeps the early part of buying under your company's control. The warehouse manager can request 20 helmets and several boxes of gloves, but no supplier receives an order until the right people review it. For common purchases, the request may start in a product catalog. Think of the catalog as your company's approved shopping shelf. Instead of typing a vague request like safety gloves, the employee can choose an approved product with a known description, supplier option, and price already attached. That saves time, but it also keeps people from buying random products that don't meet company rules. Not every request fits inside a catalog, though. A company may need a one-time repair, a consultant training, or a service that isn't stored as a physical product. In that case, Dynamics 365 can use a procurement category. A procurement category groups spending by what it is. For example, the company could use categories such as safety supplies, building repairs, legal services, or computer equipment. The requester can describe what they need and place it in the right category, even when there isn't an item number on a shelf. Now, a request shouldn't simply turn into a purchase because someone clicked submit. The company can set spending limits, budget checks, and approval workflows. A small request for gloves might go to the warehouse manager. A larger request for safety equipment might also need approval from the department budget owner or purchasing team. The route can change based on the amount, the department, or the purchasing rule tied to that type of spend. That means people don't need to remember every approval rule themselves. Dynamics 365 sends the request through the right path, while the request keeps its history inside the system. Suppose the manager requests a large amount of equipment, and the company doesn't yet know which vendor should receive the business. Purchasing can create a request for quotation, often called an RFQ. An RFQ asks several vendors to bid for the same need. The buyer sends the requirements, such as helmet type, glove size, quantities, and requested delivery date. Each vendor can return a price and their terms. Maybe one vendor costs less but can't deliver for 3 weeks. Another costs a little more but can supply everything next Tuesday. The buyer can compare those answers before choosing. Price matters, but it isn't the only thing. Delivery dates, product details, discounts, and the vendor out himself's ability to meet the request all shape the choice. The system keeps the bids connected to the request rather than leaving the comparison buried in a string of emails. Before a buyer selects anyone, Dynamics 365 also keeps vendor records. A vendor record contains the company details needed for purchasing, such as the vendor TM as name and the information used for the business relationship. Vendor catalogs can show the products that a vendor supplies, and vendors can publish those catalogs to help keep the information current. For tighter control, a product can have an approved vendor list. This tells the buyer which vendors the company has approved for that product. It guides the choice and can stop someone from selecting a supplier the company never intended to use. Some vendor relationships also involve terms negotiated ahead of time. A purchase agreement records a longer-term deal between the company and a vendor. The company may agree to buy a certain quantity or spend a certain amount over a period, and the vendor agrees to the related terms. Trade agreements record vendor prices or discounts that apply during specific dates. So if the safety equipment vendor has agreed to give a lower price on gloves for the next 6 months, Dynamics 365 can store that arrangement instead of asking every buyer to remember it. Rebate agreements can also track cases where a vendor pays money back after the company reaches a purchase amount or volume. By this point, the company knows what it needs, who can supply it, and what terms apply. The search is over, but the vendor still needs a formal order. 3. The purchase order, the company item's written promise. The buyer has chosen the safety equipment vendor. Now the company needs a purchase order, usually called a PO. A purchase order is the formal document that tells the vendor exactly what the company intends to buy. It names the vendor, lists the items or services, shows the quantity and agreed price, and includes the delivery date and payment terms. For our warehouse, the PO might list 20 helmets, 10 boxes of gloves, and a delivery date for next Tuesday. It turns a buying decision into a clear record that both sides can work from. Nobody needs to guess which glove type the company asked for, how many units it expects, or which price the buyer agreed with the vendor. A purchase order can begin in several ways. Most often, it comes from an approved purchase requisition. The warehouse manager asked for the safety equipment, the right people approved that request, and purchasing turns it into a PO. It can also come from a purchase agreement. If the company already arranged a longer-term deal with the safety vendor, the buyer can create a release order against that agreement instead of building every detail from scratch. Sometimes demand creates the order. A company may plan to buy materials because it expects future production needs, and Dynamics 365 can create planned purchase orders from that demand. When the company releases a planned order, it becomes a real purchase order. Then there are direct purchases. A buyer may create a PO manually when there is no earlier requisition, agreement, or planned demand behind it. This can happen when a buyer already knows what the company needs and which vendor will supply it. Different starting points, same destination. Before the purchase order moves forward, the company can require approval. The buyer prepares the order, but the order may need an internal sign-off based on the company automounts rules before it reaches the vendor. That separates two decisions. First, the company approves its own commitment, then the company confirms the order with the vendor, showing that both sides have agreed on what will happen. A confirmed PO is more than an internal note. It records that the order has reached the vendor and an agreement exists around the purchase. Dynamics 365 also saves buyers from retyping the same information every time they order from a familiar vendor. The vendor record can fill in details such as delivery information, payment terms, and other usual settings. The buyer still checks the order and can change details when the situation calls for it, but the normal information starts in the right place. That reduces typing and keeps repeated orders more consistent. Delivery does not always happen in one box on one day. Imagine the vendor has all the gloves now, but only half the helmets are ready. A delivery schedule lets the company split one purchase order into planned deliveries across different dates. The PO can show that 10 helmets arrive next Tuesday, the remaining 10 arrive a week later, and the gloves arrive with the first shipment. One order remains connected, while the delivery plan matches what can actually happen. Some purchases never arrive at the company at all. Direct delivery means the vendor ships the product straight to the company, IUTM as customer. For example, a business sells a specialist item but does not keep it in its own warehouse. It can create a sales order for the customer and a related purchase order for the vendor. The vendor ships directly to the customer, while Dynamics 365 connects the related sales and purchasing steps behind the scenes. This avoids an unnecessary stop at the company LTM's own warehouse and keeps the customer order and vendor order tied together, so people can follow the same item through both sides of the transaction. A purchase order can include more than the main item. Some products need related items. When the company orders helmets, it may also need replacement visors or mounting parts. Dynamics 365 can propose supplementary items, which might be required, optional, or included at no extra cost. The buyer sees the related need while building the order, rather than discovering it after the main shipment arrives. Then there are charges. Freight, handling, and similar costs can belong on the purchase order too. A charge may apply to the whole order or to a particular order line depending on how the company needs to record it. That matters because a low product price does not tell the full cost if delivery adds a large fee. Recording the charge with the order keeps that cost connected to the purchase instead of leaving it on a separate note. The vendor now has a confirmed order with clear items, prices, dates, and terms, but a confirmed order only records what the company expects to happen. Dynamics 365 still needs proof when the goods or services actually arrive. 4. Receiving goods and checking the invoice. The truck pulls up to the warehouse with the helmets and gloves. Before anyone marks the order complete, the warehouse team needs to check what actually arrived. They register the arrival, compare the shipment to the purchase order, and post a product receipt against that order. A product receipt is simply the system AuTMS record that goods showed up. Hero Thames the thing. The PO lists 20 helmets and 10 boxes of gloves, but the driver delivers only 10 helmets and all 10 boxes of gloves. The warehouse posts what it actually received, not what the company hoped would arrive. The remaining 10 helmets stay open on the purchase order until the vendor delivers them or the buyer changes the order. That keeps the record honest. Once the product receipt posts, the purchase order changes. The system now separates the ordered quantity from the received quantity, so buyers, warehouse staff, and finance can see where the order sits without calling each other. For stock items, receiving also updates inventory. The gloves appear as available stock, ready for the warehouse team to use. If the items belong to a specific project, a fixed asset, or a direct delivery, Dynamics 365 can record the purchase against that intended use instead. The company knows more than how we bought gloves. It knows whether the gloves arrived, how many arrived, and where they belong. Not every purchase reaches a loading dock, though. Imagine the company hires a safety trainer for a day, pays for software access, or brings in an outside repair service. There outcomes no pallet to count, and no warehouse arrival to register. For services and other non-physical purchases, the company can use a simpler route. Depending on how it sets up the purchase, it can register receipt on the purchase order without a warehouse step, or it can move straight to the vendor invoice. The same question still applies. Did the company receive what it agreed to buy? For a training service, the answer might be that the training took place. For a repair, someone confirms the work is complete. The record does not need a box or barcode to prove the company received something. Then the vendor invoice arrives. The invoice enters accounts payable, the part of Dynamics 365 that records what the company owes vendors and prepares payments. The invoice links back to the purchase order, so accounts payable does not treat it as an isolated bill with no history. This is where a simple check prevents a lot of trouble. Dynamics 365 compares three things: what the company ordered, what the company received, and what the vendor billed. People call this matching. Plain English, does the bill match the deal? The purchase order might show 20 helmets at an agreed price. The product receipt might show only 10 helmets arrived so far. If the vendor sends an invoice for 20, the system can show the difference before the company pays. That OTAM's three-way matching. The three records are the purchase order, the product receipt, and the invoice. When they agree, accounts payable has a clear path forward. When the price differs, the invoice quantity exceeds the received quantity, or a line appears that nobody ordered, the company can stop and investigate. Maybe the vendor sent the invoice early. Maybe freight appeared as a separate amount that the buyer needs to check. Maybe the vendor simply typed the wrong quantity. The point is not to assume bad intent. Itaut means to catch a difference while the company can still ask a clear question, rather than after payment leaves the bank. Each invoice also needs a place in the company AuTM's financial records. That UTM's the job of accounting distributions. They tell Dynamics 365 how to record the cost. The safety gloves might belong to warehouse operating costs. A new forklift might belong to a fixed asset account. A project purchase might need its cost recorded against that project. One invoice can even split across more than one place. For example, if two warehouse teams share an order of gloves, the company can divide the cost between their departments. Finance can then see where the money went without trying to rebuild that answer later from a vague invoice description. After the invoice matches and any needed checks finish, it can move through an approval process. Posting the invoice records the amount the company owes the vendor in accounts payable. The bill is now a payable. Payment terms help determine when it is due. Accounts payable can prepare the due invoices for payment, and once the company processes that payment, Dynamics 365 clears the vendor balance for that invoice. The order has now moved from an expected delivery to a recorded cost and a completed payment. But this trail does more than pay one bill. It gives the company a usable record of every decision and every handoff tied to that purchase. 5. Controls visibility and better vendor decisions. A connected purchase record also lets a company control buying before a problem reaches finance. Purchasing policies set the ground rules. They guide what employees may request, which vendors they can use, and when a purchase needs approval before anyone commits company money. Think about the safety equipment request. The company might require warehouse staff to choose approved safety products, while only the purchasing team can choose a new vendor. A small replacement order may need one approval, but a large order for a whole new team may need a budget owner and a purchasing manager. The rules sit inside the process. People don't now need to search for a policy document, guess who needs to approve something, or forward an email until somebody replies. Dynamics 365 can route the request based on the department, the amount, the type of purchase, or the policy attached to it. That route is called a workflow. A workflow gives requests, purchase orders, and invoices a clear path from one person to the next. Each person can approve, reject, or send the record back for changes, and the system records the action. No more wondering whether an approval happened in a long email chain. This also helps when someone is away. The work does not disappear into that person item's inbox with no sign of where it stopped. The company can see the current step and act on it. Vendors can take part too when the company uses the vendor portal. The vendor portal gives a vendor a place to view requests for quotation or purchase orders shared with them. They can respond to a request for quotation, and they can confirm an order directly when the company sends a confirmation request. That gives both sides the same document to work from. Instead of a buyer sending a PDF, then waiting for a reply, then typing the reply back into the system, the vendor can confirm the details through the connected process. The buyer can see the response without rebuilding the record by hand. Once purchases move through the system, the company also collects useful information without creating another spreadsheet. Spend analysis answers a simple question: where is the money going? A purchasing manager can review spending by vendor, product, procurement category, or department. Maybe the company thinks it buys gloves from one supplier, but the records show several teams buying similar gloves from different vendors. Maybe a department spends more on outside repairs than expected. Those details give the company a reason to ask better questions before the next purchase. Vendor performance analysis looks at the vendor side of the same story. Buyers can compare purchasing and delivery results when they decide who should receive future orders. A low price on paper may not look so attractive if the vendor repeatedly delivers late, ships incomplete orders, or cannot meet the agreed terms. The company can use its own purchase records when it reviews that vendor relationship. Then there is the audit trail. An audit trail lets someone trace a purchase through its full history. They can start with the original request, see who approved it, review the purchase order, check the receipt, find the invoice, and see the payment that cleared it. That record helps finance and audit teams, but it also helps ordinary people answer ordinary questions. Why did we buy this? Who chose this vendor? Did the goods arrive? Has the invoice already been paid? The answer sits with the purchase record. Go back to the office building from the start. The purchasing desk, the receiving dock, and the finance desk have different jobs, but they are all looking at parts of the same purchase instead of passing loose papers between separate rooms. Our warehouse manager, our TMS request for helmets and gloves now has a full history. The request followed the company policy. The right people approved it. The vendor supplied the equipment. Warehouse staff recorded the delivery. Accounts payable matched the invoice and paid it. One simple distinction keeps all of these building blocks clear. Sourcing helps the company choose who to buy from, while procurement manages what happens after the company decides to buy. Conclusion: one connected record from need to payment. Here's the big picture. Procurement and sourcing takes all those scattered handoffs and turns them into one tracked company process. A request doesn't vanish into an inbox, an approval doesn't live only in someone's memory, and an invoice doesn't arrive without a clear link to the decision behind it. Instead, the company has one connected record that follows the purchase all the way through. That gives you a clear answer when you need one. You can see the order as the buyer. The warehouse sees what's expected. Finance knows what the company owes. And managers see exactly where spending is going. Buying still involves people, vendors, goods, services, and decisions. Dynamics 365 doesn't remove those things. It keeps the record of them together, so you can buy with fewer loose ends and fewer surprises. Subscribe on your favorite podcast platform and share this knowledge nugget with someone starting to learn Dynamics 365 procurement and sourcing.